the S&P 500 down roughly 2.5%. Well, our next guest is going to share an idea on how to play off the coronavirus news that is slamming stocks. We're joined by Andy Kapyrin, research head at RegentAtlantic. Well, Andy, you say you've got a long-term strategy, but before we get into that, this just crossed the wire. The Federal Reserve Chair Jerome Powell issuing a statement saying that the coronavirus poses risks to economic activity, but saying that the Fed will use its tools and act as appropriate to support the economy. What do you think he means by that in terms of possibly movement on interest rates?
So I think the market was already predicting that the Federal Reserve was highly likely to cut 25 basis points off of the federal funds rate to a target of 1.25 to 1.5% next month. This statement, I think, reinforces the market's belief. I think it's important for the Fed to make this statement to hedge its bets, but also to give the market a boost of confidence. Intervening in between meetings, it would be a highly extraordinary event for the Fed. They seldom do this. I think waiting for the next meeting, though, they're all but saying that there will be a cut.
Do you think it'll be effective in stopping the sell-off?
So there are two sides to this sell-off. One side is that credit is becoming more expensive, and you can see it because investment-grade bond spreads, so the cost to borrow for a corporation versus the Treasury Department, is starting to rise. High-yield bond spreads are starting to rise. Stocks, of course, are falling. All this creates the perception and the reality that capital is more scarce, capital is harder to come by. It will be effective in limiting the financial contagion. Here's the problem, and here's how this is different. Over the past 10 years, we have avoided a bear market in the U.S. because every time there was the risk of financial contagion, the Fed came out with a quantitative easing bazooka, standing ready to inject huge amounts of capital, huge amounts of liquidity, keeping interest rates low. This will be effective in limiting financial contagion. It may not be fully effective at limiting the economic impact of the coronavirus, because this is not a monetary phenomenon. This is strictly happening in the real economy for goods.
Okay, so possibly limiting financial contagion,
yeah,
but as you say, not on the impact of the virus. Now let's get to your theme. You say that there's a way to play it, and you say it deals with tends to do with globalization.
Mm-hmm.
Explain that.
So I think the coronavirus plays into a broader theme that we are already experiencing in the world. If you look at U.S. elections recently and U.S. political reality, it is that we're becoming a more insular country. We're erecting more barriers to trade. We're erecting more barriers to immigration, and it is not a U.S. phenomenon alone. You see it in Europe with Brexit. You see it throughout the world. Governments are acting on more authoritarian impulses more quickly, making trade harder to do. And I see that as something that is going to result in globalization plateauing. I don't think it's, so I need to draw a distinction here. It's not deglobalization. We're not going to do less trade than we currently do. It's just that the trade intensity of global growth is probably not going to be very high going forward.
If that's the case, what should you do with, for example, international funds or emerging market funds?
So emerging markets and international funds will still make up an important piece of a broadly diversified portfolio. They are still cheap. They are still an attractive investment to include. But maybe it makes sense to limit how much you expose yourself to these investments, because they stand to lose the most in a less global world. They depend the most on growth in trade and not just a status quo.
Then what would you pick up based on your globalization thing?
So some of the investments that make the most sense in a deglobalizing world, you also want to consider the stage of the economy that we're in. We are clearly in the late stages of an economic cycle. That's why news tends to hit stocks harder. That's why unemployment is at a multi-decade low. That's why inflation is actually starting to run a little bit higher. All these things suggest the late cycle economic environment. In the late cycle, real estate is a really attractive investment because it has stable, predictable cash flows. When vacancies are low, which is what happens in the late stages of an economic cycle, that's when real estate can really grow its net operating income. The way investors can invest in real estate in a liquid form is by buying real estate investment trusts. These are highly attractive companies that own and operate real estate throughout the United States. They can be a good contributor to a portfolio.
But REITs, they tend to be a good bet on in a rising interest rate environment. And certainly you can argue that the Fed funds futures is extended at 1.15%, that we have have today. But then again, here we are. We just started the news talking about a possible interest rate cut.
Yep.
Wouldn't that hurt REITs, or are you talking about it long term?
So I am talking long term, but I'm also, you have to consider how interest rates and REITs interact. Real estate investment trusts are an income alternative. They're a substitute for bonds. So if bond yields are dropping, it should make REITs more attractive to investors as an alternative source of income for investors. That actually hasn't played out over the past few weeks. You've seen real estate investment trust stock prices fall in tandem with the stock market, even though bond yields are plummeting.
All right. Thanks a lot, Andy, for those thoughts and those ideas. Appreciate it.
Thank you, Fred.
Our thanks to Andy Kapyrin of RegentAtlantic. I'm Fred Katayama, and this is Reuters. Have a wonderful weekend.